Well, today's financial news coverage is mainly focused on the autumn statement. Probably the most significant economic news yesterday was the postponement of the OPEC Plus meeting this coming weekend. With signs of fracturing within the cartel, this cast doubt on its ability to implement production cuts. In a demonstration of the fragility of the world's most critical and rigged energy market, benchmark oil prices fell over 5% on the news, albeit they did recover later. The recent decline in global energy prices went pretty well unnoticed by the UK's OFGEM energy regulator, which announced that the UK retail energy price cap would rise by 5% in the new year. As the US takes its Thanksgiving holiday, the UK is busy absorbing yesterday's autumn statement. As usual, the Chancellor pulled fewer rabbits from his hat than the build-up might have suggested. The political theatre attached to this event ramps up as election year approaches. In summary, the giveaways, such as national insurance reductions and increased investment allowances, were less than the inflationary-fueled fiscal drag on tax revenues. Hence, the UK will still have its highest tax take as a proportion of GDP since World War II. However, it is worth noting that the UK's GDP is a full 2 percentage points higher than forecast by the OBR only 6 months ago. There are no new measures to address the functioning of the UK's capital market, and the only direct action for stock market investors was a plan to revive the If You See SID campaign to widen share ownership and sell off the Exchequer's remaining holding in NatWest Bank to retail investors. This holding is a hangover from the global financial crisis, which the government has struggled to offload to institutional investors for the last 14 years. It was recently embroiled in the debanking scandal that cost NatWest its CEO. Perhaps the campaign should be renamed If You See Nigel, Please Don't Tell Him. Not much to talk about in the UK company news this morning. Motorpoint Retail, the used car supermarket, reported significant H1 revenue and profit declines driven by lower volumes and a fall in finance commissions. It also suffered an increase in finance expenses during the period. More recently, it has seen reduced wholesale used car prices of about 6% in just the last 6 weeks. More deflationary signals.